Today, we're doing something really interesting. We're going to tear down a real analyst report from Goldman Sachs to show you how to read between the lines of a big financial headline. We're going to find the real story behind some huge numbers.
So you see a headline like this, right? A company's profit shoots up 41%. Your first thought is probably, wow, they must be crushing it. But for a real analyst, that number isn't the end of the story. Nope, it's just the beginning.
And the company we're putting under the microscope is Hong Kong Exchanges. You'll see it called HKEX. Just think of them as the people who run the stock market itself. They make money when people trade stocks, when companies go public. You get the idea.
All right, let's start with that incredible result. Because on the surface, man, it really looks like HKEX hit an absolute home run with their latest earnings report. There it is, 41%. That's how much their profit jumped. I mean, that's not just good, that's the kind of number that gets investors really, really excited.
And just so we're all on the same page, we're talking about their net profit growth compared to the same time last year. It looks like a massive sign of success. Or does it?
But the good news didn't stop there. The report also pointed to this number, $3.51. Now, this one's a little more technical, but it's super important. That's the company's earnings per share, or EPS. It's a key way to measure how profitable a company is. And here's the thing. They didn't just meet what analysts expected. They beat the forecast from Goldman Sachs by a solid 9%. So you've got this huge profit jump, and they surprised the experts. This seems like a perfect story, right? Well, that's exactly when a good analyst starts to get curious.
Okay, this is where we start to peel back the onion, because the really juicy part of an analyst report isn't just the final number. It's how the company actually got there.
This is the question, the big one. Did all that extra profit come from their main job, running a busy stock exchange? Or did it come from somewhere else?
See, for a company like HKAXE, you can pretty much split their income into two big buckets. There's the money from their core business, all those trading fees, and then there's something called investment income. The difference between these two is everything in our story today.
So what is investment income? The simplest way to think about it is this. It's the money a company makes from investing its own cash. It's got nothing to do with their day job. For HKXEX, this is profit that has zero connection to the buying and selling of stocks on their exchange. And here we go. This is the heart of it. Look at this. The report shows that, yes, overall profit beat the forecast by 9%. But, and this is the kicker, if you take out that investment income and only look at their core business, they actually missed the forecast by 2%. Let that sink in for a second. The actual day-to-day job of being a stock exchange was a little weaker than everyone thought. The entire reason for that 41% headline, that massive beat, had nothing to do with their main business. It was all smoke and mirrors from somewhere else. And this chart just shows you how wild it was. HKEX's investment income wasn't just a little better than expected, it was a monster, coming in 35% higher than what Goldman Sachs had predicted. This one thing, which isn't even their main job, was so huge that it single-handedly dragged the company from a slight miss to a massive beat. So after uncovering all of this, what's the final call from the analysts? Where does Goldman Sachs actually land on this? Is it a buy, a hold, or a sell?
Well, you gotta love this. They put it right there in the title of their own report. They're not hiding it. Beat led by higher investment income. And then right after that, buy. So there you have it. Even though the core business was a little soft, the overall financial health, boosted by those investments, was strong enough for them to tell clients to buy the stock. And they don't just say buy, they give a specific price target, 500 Hong Kong dollars. Basically, that's the price they think the stock could realistically reach in the next year or so. But hold on, we're not done yet. Any good analyst report, any professional report, always looks at what could go wrong. You have to understand the risks just as much as you celebrate the wins. The analysts flag a few potential problems on the horizon. Things like increased competition, maybe a slowdown in trading activity, and even pressure on them to lower their fees. All things that could hurt that core business even more. And finally, you always have to read the disclosures, the fine print. In this case, the report clearly states that Goldman Sachs, the bank writing the report, also does investment banking business with HKEX, the company they're analyzing. Now, to be super clear, this is a totally normal, legally required disclosure. It doesn't mean the research is wrong or biased, but it's really important context for you, the reader, to have.
It's a good reminder to treat any analyst report as one piece of the puzzle, not the whole picture. So what's the big takeaway here? It's that a flashy headline can hide a much more interesting truth. That amazing 41% profit beat, it wasn't a story about a booming stock market business. It was the story of a company making some really smart investments. And that's the power of just digging one level deeper. So the next time you see one of those big flashy headlines, you'll know what to ask. Where did that number really come from?